Here is the situation every trend trader faces. Price has been moving in your direction. You are positioned correctly, the structure is clear, and then price pulls back. And in that pullback, doubt creeps in. Is this the end of the trend? Is this a change of character? Should I exit now before it gets worse? And then price recovers and breaks above the previous swing high. And the trend continues. That moment, when price closes above the previous swing high, that is a break of structure. And it is the single most powerful confirmation that a trend is continuing that exists in all of market structure analysis. This video teaches you to read it, trade it, and never confuse it with anything else again. Video 10 of the Complete Trading series. Let's get into it. In video 9, we learned that a change of character is the first structural evidence that a trend is ending, a close below the most recent higher low in a bullish trend. The sellers broke through a level the buyers previously defended. That was the warning. The break of structure is the opposite signal. It is the confirmation that the side in control is still in control, that the pullback was just a pullback, that the trend has refueled and is ready to continue. Every professional trend trader waits for the break of structure before adding to positions or entering new ones. Because the break of structure is evidence, not prediction. It tells you what has already happened, not what might happen. And in trading, evidence always beats speculation. What a break of structure actually is. A break of structure in a bullish trend occurs when price closes above the most recent swing high. Not any swing high, the most recent one. The last peak that was formed before the pullback began. When price closes above that specific level, it has done two things simultaneously. It has confirmed that the current pullback is over, and it has confirmed that the buyers had enough conviction to surpass the previous high, which means the upward sequence of higher highs is continuing. The structure is intact. The trend is alive. In a bearish trend, a break of structure occurs when price closes below the most recent swing low. The sellers pushed price to a new low, exceeding the most recent trough. The downward sequence of lower lows is continuing. The bearish structure is intact. Every time you see a break of structure in the direction of the established trend, you are watching the dominant side prove they are still dominant. The close requirement. Why it matters every single time. A wick above the most recent swing high is not a break of structure. A candle that touches the swing high level and pulls back is not a break of structure. Only a candle close above the swing high qualifies. We covered this in video 9 from the change of character perspective. The same logic applies here with equal force. A wick tells you buyers reached that level, but sellers pushed back before the period ended. The sellers won that specific negotiation. A close above tells you buyers reached that level and held it when the period ended. The sellers could not push back enough to prevent the close above. The buyers won the final verdict. This distinction removes an enormous amount of noise from your structural analysis. On any active chart, you will see price frequently touching and briefly exceeding previous swing highs with wicks before pulling back. If you counted every wick as a break of structure, you would be seeing break of structure signals on almost every candle. The close requirement filters out the noise and keeps only the signals that actually represent a genuine shift in the balance of power at the structural level. A strong break of structure has three characteristics. The break candle is large and decisive. A full-bodied candle that closes well above the swing high, not just barely above it. The body of the candle extends significantly beyond the swing high level. Volume on the break candle is expanding. More participation than on recent candles means the buying is conviction-driven. Institutional participation is visible through the size and volume of the break candle, and the break follows a clean, well-defined pullback to a logical level such as an order block, a fair value gap, or the most recent swing low. The retracement that preceded the break was orderly and structured, not a chaotic, choppy grind that spent too long at the support area. A weak break of structure has opposite characteristics. The break candle barely closes above the swing high, just a few ticks or pips above the level. Volume is not expanding. Low participation suggests the break lacks conviction, and the break happens after a messy pullback that spent too long grinding at the support level, suggesting the buyers defending that area are weakening rather than consolidating for the next push. A strong break of structure is a high-quality signal to enter with the trend. A weak break of structure is a caution signal. It may still lead to trend continuation, but it requires additional confirmation before entering. And the additional confirmation is the retest, which we will cover shortly. The retest after a break of structure. After a genuine break of structure, price frequently returns to retest the level it just broke. In a bullish trend, after price closes above the most recent swing high, it often pulls back to that broken swing high level before continuing higher. This pullback is the retest, and the retest is one of the highest probability entry points in all of trend trading. Here is why. The broken swing high is now a structural level with a specific mechanical meaning. It was the previous peak where sellers once had control. Price broke above it and closed there. Now when price returns to that level from above, two things are happening simultaneously. The level that was once resistance is being tested as new support. And the order block that created the break of structure, the cluster of buying that drove price above the swing high, is being approached from above. Both factors create buying pressure at the retest level. A trader who enters at the retest of a broken swing high in a bullish trend has several advantages. Their entry is at a defined structural level with a clear invalidation point just below the retest level. Their stop loss is tight and logical. The level must hold for the break of structure to be genuine. If it breaks, the break of structure was false, and the stop protects them from holding a bad position. And their potential reward is the continuation of the established trend from the highest probability entry point within it. Break of structure versus change of character. The final distinction. This is the comparison that determines everything in structural trend trading. And it is the comparison that video 9 and video 10 together are designed to make absolutely clear. The break of structure and the change of character are mirror images of each other. They are both breaks of swing points, but they break different swing points. And breaking different swing points means completely different things. In a bullish trend, the break of structure breaks the most recent swing high. This is a continuation signal. The buyers have proven they are still stronger than the sellers at the highest structural level. In the same bullish trend, the change of character breaks the most recent swing low. This is a potential reversal signal. The sellers have proven they can overcome the buyers at a level the buyers previously controlled. One breaks the high, one breaks the low. Same trend. Opposite meanings. The only question you need to ask in real time is this: which swing point just broke? If a high broke, it is a break of structure. Continuation. If a low broke, it is a change of character. Potential reversal. That single question, applied consistently to every break you observe, gives you the structural clarity that most retail traders never develop. Reading break of structure signals on multiple time frames. A break of structure on the daily chart is one of the most significant signals in market structure analysis. It tells you the highest level participants in the market, the institutions trading the daily time frame, have pushed price beyond the previous peak. That is not a signal to ignore. When you see a daily break of structure, you drop to the 4-hour chart and look for the retest. The daily break of structure established the direction. The 4-hour retest gives you the entry. And the 1-hour chart gives you the specific trigger candle at the retest level. On the 4-hour chart, a break of structure that aligns with the daily trend is a high-quality setup. On the 1-hour chart, a break of structure that aligns with both the daily and 4-hour trend is an excellent entry timing signal. The significance of a break of structure is multiplied when it aligns across multiple time frames. A 1-minute break of structure in the direction of the daily trend is slightly relevant. A daily break of structure confirmed by a 4-hour retest with a 1-hour entry candle is a complete, multi-timeframe setup with full structural context behind it. The most common break of structure mistakes. The first mistake is treating a wick above the swing high as a break of structure. We have covered this multiple times, only a close qualifies. But it bears repeating because traders make this mistake constantly, especially in real-time analysis when the candle is still forming. A candle that is currently above the swing high with 30 seconds remaining in the period is not a break of structure yet. Wait for the close. The second mistake is entering immediately on the break candle without waiting for the retest. The break candle itself is often extended, and buying at the high of a break candle means buying into a level where sellers are likely to step in and push back. The retest gives you a better entry with a tighter stop. Patience after the break is rewarded more than aggression on the break. The third mistake is treating every break of structure as equal regardless of time frame context. A break of structure on the 4-hour chart against a bearish daily trend is not the same signal as a break of structure on the 4-hour chart aligned with a bullish daily trend. Context from the higher time frame determines the significance of every break of structure on the lower time frame. Trade breaks of structure that align with the higher time frame trend. Avoid breaks that go against it, putting break of structure and change of character together. Now that you have both concepts, let me show you how they work together to give you the complete picture of any trending market in real time. In a bullish trend, you are watching two levels simultaneously: the most recent swing high for the break of structure and the most recent swing low for the change of character. As long as price makes new break of structures without triggering a change of character, the trend is intact, and you look for long opportunities at the retests of each break. The moment a change of character triggers before a new break of structure, the trend may be changing and you stop looking for longs until the structure clarifies. This dual-level watch creates a complete structural framework. You always know the two levels that matter most: the one that confirms continuation and the one that warns of reversal. Between those two levels, the market is giving you real-time structural information with every candle, and a trader who reads that information fluently, using correctly identified swing points and the close-only qualification rule, has a structural understanding of the market that most retail traders never achieve. Drop a comment. In the market you trade right now, identify the most recent break of structure. Was it strong or weak? Did it retest? I read every single one. See you in the next video. Stay disciplined.